It's time for the Trading Stocks Made Easy podcast. Each week, Trading Stocks Made Easy demystifies stock trading and investing so you can profit big. And now, here's the host of Trading Stocks Made Easy, the wealthy investor, Tyrone Jackson.
Hey, it's Tyrone Jackson, the wealthy investor. Welcome back to episode number 83 of the Trading Stocks Made Easy podcast. You know, I try to teach you as much as I possibly can in this podcast about what goes on Wall Street. Today's episode, very fascinating because we're going to talk about what makes a stock price go higher. As you've heard in the past, the simple answer is revenue. See, we never pick stocks in the Wealthy Investor Program based on luck or feeling, or as we sometimes see in the movies, a guy who says, I have a hunch. Hunches are the fastest way to actually lose money in the stock market. We make wise choices based on revenue. What kind of revenue? Top-line revenue. And we also like stocks that have revenue streams. That means not just one way of generating billions of dollars, but several ways. So if you're really interested in picking stocks that have the greatest probability of going higher, today's episode is for you. And we're going to get started with learning about corporate revenue streams right after you take a listen to this.
Want to increase your stock market trading profits? Then you need to start your monthly membership to WITradeschool.com right now. Don't know which stocks to choose for trading in today's market? No problem. Just follow Tyrone Jackson's hot stock picks inside WITradeschool.com. At WITradeschool.com, you could also follow Tyrone's weekly stock market tutorials and investing advice. Plus, each week you can submit your trading and investing questions directly to our staff, and Tyrone will answer them as part of our weekly video Q&A sessions. Begin your membership right now and you'll get instant access to WITradeschool.com's video library. That means you'll get to know all of Tyrone's major and minor trading strategies, including covered call writing and volatility trading for fast, sexy profits. Tyrone Jackson, the wealthy investor, has helped his students earn thousands of dollars per month trading stocks online from home. These are people just like you. In addition to a successful podcast, Tyrone's editorial content has been featured on CBSMoneyWatch.com, NASDAQ.com, and YahooFinance.com. So what are you waiting for? Follow Tyrone Jackson's red-hot stock trades and investment strategies today. Don't wait. Start your monthly membership at WITradeschool.com right now.
And welcome back. Now, let's dive right into corporate revenue streams. So, every once in a while, I'm walking around and someone says, hey, Tyrone, what's your favorite stock, right? And I usually give people my standard answers about my favorite stocks in the Dow Jones Industrial Average. And then someone invariably will mention some stock that I've never heard of that's trading at, let's say, in the $20 or $30 range. Now, in the Wealthy Investor Program, we have a tendency to trade stocks between $50 and $100. We refer to that as our sweet spot because those companies whose stock prices reach that range generally have multiple revenue streams. And when you have multiple revenue streams, you are constantly increasing the amount of income that a corporation has coming in, and those make good dates. Remember, in the Wealthy Investor Program, we never fall in love with a stock. We only date them. One of the reasons why people actually lose money in the stock market is because when a corporate revenue stream goes down or the income from that stream goes down, very often the investor or trader goes into a kind of denial. And they say, well, the stock is temporarily down even though they lost that revenue stream, or they have no financial education and they rely on a what? A hunch. Never rely on hunches when it comes to investing your money. So just to give you a picture of how when a corporate revenue stream is established, how a company can build on that stream, I'm going to talk to you about 3 different stocks. The first stock I want to talk to you about is a company called Facebook. Now, Facebook's ticker symbol, as many of you know, is FB. From 2013 to 2018, the stock went from a low of $41.29 to a high of over $200. Now, that's quite a return as a shareholder if you were investing in the stock for a long term. Now, what makes Facebook or what made Facebook such a great investment? It was their ability to grow their subscribers. You see, by 2018, Facebook had over 2.1 billion subscribers. So if you have a Facebook page, you know that Facebook makes most of its money off of those ads that show up in your feed, and those ads are essentially targeted, meaning most of what you're seeing in your feed has been chosen to show you based on your interest profile that you filled out when you first joined Facebook. If you can recall, you told them what movies you like, what kind of music you like, and they had that data, and companies that buy ads on Facebook can target people based on their profile. Therefore, the advertiser gets a rate of return because they're reaching people who are most likely to be open or willing to purchase that product. What the advertiser does is send their ads out to, let's say, 500,000 people on Facebook. And out of the 500,000 people, if they can get 500 people to purchase a product at, let's say, $100, then the advertiser can measure the amount of money they spent versus what the ad actually brought in. So this method of marketing has stolen billions of dollars away from radio and TV, because when you run a radio and TV ad, since the listener can't click and go right to the website and make a purchase, Facebook ads have put traditional media somewhat at a disadvantage. So the more people who see targeted ads on Facebook, presumably the more revenue that Facebook can actually earn. And they're doing really well because they were the first online company to monetize mobile. As we say in the stock market, what does that mean? They're the first company that experienced people watching an ad and purchasing something from their phone. So this represents a new change in digital marketing and new advertising. Well, today's show is all about Facebook's revenue streams. And here's the thing that's really interesting. Facebook doesn't have a second revenue stream yet. But you see, they have 2.1 billion people who actually are on their service every single day. They say like 80% of the 2.1 billion are what they call active users. So if Facebook actually launches Facebook TV, where certain celebrities and media outlets can produce programming that just lands on Facebook, they will have a second revenue stream. And if Facebook TV, for example, really takes off, presumably the ad revenue on the TV side would be different from the ad revenue that's simply generated on still ads that you see in your feed. So they have a lot of running room with their platform. So since Facebook is so new still as a publicly traded company, over the next 3 to 5 years, I would expect we'd see multiple streams develop. As that revenue rises, then the stock price will go well beyond $200 per share. If you're a shareholder, remember you can read all the company's press releases on their websites, and it'll actually tell you what's known as a forward-looking statement where they plan to go in the future. And as shareholders, that's something that guides us and helps us decide whether we want to increase the amount of shares that we actually own in Facebook. Let's move on now to a company that does have multiple revenue streams, which is Google. They changed their name as a publicly traded company to Alphabet. But Google's shares from 2013 to 2018 went from $420 to over $1,200. Now do you see why there's so many millionaires and billionaires made in the stock market? Because there are people who just invest in new technology like Facebook and Google. I myself still prefer members of the Dow Jones Industrial Average, but I do own shares in Facebook in particular because it's simply a business model that I actually understand. Now, Google has similar ad revenue streams. Their primary way of generating billions and billions of dollars is through search. Now, when you search for something on Google, the next time you're searching and you put in, let's say, dating, you're going to notice the top 3 selections will have a tiny print next to it that says ad. That means that advertiser is paying in something called PPC, pay-per-click advertising, right, to be in the first, second, or third position in front of you when you put in a search term for, let's say, dating. Now, Google also has a suite of other services, including email suites, or the service they have called eSuites, where they charge businesses and small enterprises for actually hosting their email. They have other streams that complement G Suite, and they're looking for new streams all the time. They're always testing. Well, when they develop a new revenue stream, they pile that revenue on top of their search revenue, and that's why the stock has gone from $400 to over $1,200, because they keep hitting all these new streams that generate more and more revenue. Now, if you're already a member of the Wealthy Investor Program, you know we talk about top-line revenue, which encompasses all of the revenue streams. But I just wanted to point out that there are multiple streams being developed almost weekly at Google. They add some, they drop some, but they never abandon search, which is their primary way of actually making money. So Google and Facebook are in the online ad business, as we call it. They are competitors. So as Facebook came into being, guess what? A lot of advertisers switched from Google to Facebook because Facebook was charging less for their online ads, and some people say their targeting was better. Now, it's really interesting because when you start investing in a company and you start understanding what their revenue streams are, you understand the nuances, and you can almost predict whether revenue on a quarterly basis is going to go up or going to go down. Now, I know on the show I talk to you a lot about your wealth consciousness and your money beliefs, but there really is a whole skill to just choosing winning stocks, and fundamentals and revenue streams is part of that. Now I like to turn my attention to one of my favorite stocks that has only one revenue stream, but 10 times the opportunity to develop more. And that is Netflix, ticker symbol NFLX. In 2013, that stock was trading at $40 per share. And in the middle of 2018, it went to over $400 per share. Now, Netflix is still in its infancy. It's still in its embryonic stages as it relates to its streams. It has one stream right now, which is subscriptions. Early in 2018, they added about 5 million new subscribers in their second quarter, which means that their revenue is going to rise. But what would happen if Netflix actually added Netflix Sports for an additional $2.99 a month? Well, when you have almost 1 billion people subscribing to your service and you say, hey, do you want our 24-hour sports network? What's going to happen to the revenue if just 50% of the subscribers say for $3 a month, I'll take soccer and basketball and football and even golf? That means that Netflix has huge running room when they announce their next revenue stream. And if you could get Netflix programming along with their sports for only an extra $3 a month, would you do it? Well, millions of people around the world would, which would ask the question, if you're getting programming plus sports, why do you have cable? So Netflix is what's known in the stock market as a disruptor. It's disrupting, it's changing how other companies do business. That's why you're going to see your cable company offering you something called skinny bundles. What's a skinny bundle? It's the cheaper version of cable. They have to bring their price down. So the generational shift that we're seeing these days is most people have cut their landlines. They've cut their cable service. In fact, in the industry, we call that cord cutters. They've reduced their costs by simply keeping a cell phone bill and a Netflix subscription. If you're working 40 hours a week, for many people, they feel like, I can't watch those 700 cable channels. I just want Netflix, access to the internet, and a cell phone, and I'm paying a fraction of what I was paying for cable. So our landscape is constantly changing and being shaped by this new technology. What you want to decide is which one of these technology stocks should you own now. Now, here's the good news. Within the next 2 to 3 years, there are going to be other disruptor companies that offer brand new services that we don't even know about that make access to the internet and digital content even cheaper. Some of these companies will go public within the next 36 months. Great time to buy them once they have 4 quarters of top-line revenue growth and 3 years of annual revenue growth. See, what we do in the Wealthy Investor Program is we don't speculate on a stock's future boldly without there being proof on the fundamentals that the stock could go higher. So we don't guess at a stock. We wait for these new technology companies to go public. We give them 3 years to grow their revenue. If they're in strong upward trends, then we know it's time to own them. Back in a moment.
You're listening to the Trading Stocks Made Easy podcast. Want to learn more about how to trade and invest in the stock market? Visit thewealthyinvestor.net/products. That's thewealthyinvestor.net/products and order the Wealthy Investor's Guide to Stock Market Success audio series. This easy-to-follow 5-CD audio series and manual will teach you the basics of how to buy and sell stocks. how to collect quarterly dividends for life, plus hidden income generating strategies like covered call writing and volatility trading. Start creating financial freedom right now. Get the financial education you need to get ahead. Visit thewealthyinvestor.net/products.
Now, I want to mention one other thing in this episode, since it was really just a brief recap about revenue streams. Some of these new technology stocks, when they go public or after they've had 3 years of top-line revenue growth, they are going to be in the $50 to $100 range. And we refer to those stocks in the Wealthy Investor Program as our sweet spot, right? So if you're getting started investing or trading, everybody likes to buy a stock that's worth about $55 on its way to $200 a share. Isn't that great? Right. When we're in the $50 to $100 range, we're somewhat challenged because those stocks that lie in that range very often make great stocks for covered calls. So the pattern that I've been seeing over the past 10 years as it relates to growing your money is we very often trade stocks in the $50 to $100 range. When they go over $100 a share, we no longer touch them. We hold them for the long term. And the reason for that is because stocks that go over $100 a share tend to attract a lot of institutional money, and that's what pushes the stock from $100 to $200. So for a lot of retail investors, people who buy and sell stocks on their own, they say, no. I don't want to own any shares of a stock that's going over 100 because I'm looking for the next cheap stock. And in this world where technology is driving the stock market, that is simply the wrong approach. You want to own shares of stocks that are going over $100 a share because those are the shares that have the greatest probability of going up to $200 and $300 per share. Now, why is this basic math and concept so important? Because if I can own 300 shares of a stock at $100 a share within a year and a half, those shares are $200. That is a 100% return. So anybody who's ever attended any of my online webinars, you know how I feel about this approach because it's very, very, very consistent. When that stock crosses 100, it is on its way to $200, $300, $400 a share because all that institutional money flows into the stock. So you see, when I talk to you about getting a financial education, I'm referring to understanding many things. Not only the inner game of wealth, how you feel about your money and discipline, but understanding how publicly traded companies make their money, how they scale up and increase their revenue streams. Those revenue streams, if done correctly, create shareholder value and an increase in top-line revenue. You see, there really is a lot to know if you really want to play this game and play it well. And that's why, for those of you who are outside of New York and LA, you want to join WITradeschool.com. Because as trends change in the market, I can keep you apprised of what they are. And I received the greatest compliment a couple of weeks ago because WI Trade School is all video-based. There are hundreds of videos that cover the stock market. So if you really want to study the market, you simply just watch the videos and the video content inside. If you want a volatility trade, I teach you how to volatility trade. If you want to know what hot stocks are, it's all there in Trade School. And someone said WI Trade School is like a mini Netflix for stock market traders. Now, can you imagine how good that made me feel? Hey, listen, it's Tyrone Jackson, the Wealthy Investor, saying, I hope you've learned something in this episode and just at least become acquainted with the fact that we're not guessing about what stocks make us wealthy in the Wealthy Investor Program. We're choosing them according to a specific methodology and an approach. Remember, without a financial education, it's hard to change your life. I'll see you right back here on the next episode of Trading Stocks Made Easy.
You've been listening to the Trading Stocks Made Easy podcast. Be sure to rate and review our show on iTunes. While you're on iTunes, be sure to click the subscribe button and you'll automatically receive our next episode.